Time to see what's on the radar for Barry Schwartz, President and CIO at Baskin Wealth Management. And on the radar, the energy sector and CNQ.
We bought CNQ for clients in 2022. The stock did not work for a couple of years. We bought it as oil prices were much higher than they are today, maybe in the $75 to $80 range. But what gave us confidence to own the stock for the long term is the management team, the fact that they have these long life, decades of reserves. We talked about earlier the Shell story about how they need to find more production. Hello, CNQ doesn't. They have decades of reserves. They would be able, if the government said, go and here's the infrastructure, they'd be able to double the production in a very short period of time if they wanted to. Doesn't make sense to do that, of course, but that's the opportunity. We thought it was trading at a deep discount to some of the super majors. With all these long life reserves, the fact that it raised the dividend 25 plus years in a row with crazy up and down volatility in commodity prices just shows you how good an operator CNQ is. So here it is, an all-time high. I'm not a particular genius on this stock. The Suncor's at an all-time high, Imperial Oil, Cenovus. So, all those companies are doing well. It goes to show you that you don't need a view on oil prices to own oil stocks. You need a view on, obviously the company has to increase production, organic growth, but you need a view more on the management team and the ability. So what do you do now with the stock when it's trading at a higher valuation? I still think there's good upside here. Obviously, if there's more tensions in the Middle East, oil prices could rise, but that's not what I'm betting on. I'm betting on over the long term, they're going to increase production, buy back a lot more stock and pay dividends. And at the $60 range of oil, the company's extremely profitable.
And do they stand to benefit from the federal government, the infrastructure program? Hard to tell, right? All right.
So when you see a headline like Enbridge
does their name get mentioned in it then?
Yeah, it's. Eventually, I think Canada will build out more infrastructure. We certainly have countries that want to buy our assets, but it's going to take time.
Yeah. And dividends, what's it paying out?
Around 4%, but we expect the company to raise the dividend every single year, and they raise it with production growth, and they're just great operators. And even with a spike in inflation, they've been able to keep costs low.
And how important is it manage? You said that management is really everything, isn't it, for a lot of the time?
If you're a long-term investor, it really is all that matters. You want to have be partnered with a management team that understands how to allocate capital, that's been through troubles before, that's been through downturns, that most importantly has incentivized compensation. They have skin in the game. They have significant ownership in the stock. You want them to suffer when you suffer, and they have a long-term view and approach. And they're not trying to beat earnings in this quarter. They're trying to think about how we're going to build the business better over the long term. So if the stock doesn't do anything for a few years, that's fine to us, as long as we have a view to the long term.
All right, another one we want to look at: Domino's Pizza. I don't know. It sounds funny to be talking about Domino's Pizza, but it's gigantic.
Domino's Pizza is the market leader in North America in terms of carry-out and delivery. Its competitors, Pizza Hut and Papa John's in the U.S., have been losing market share. Domino's, kind of like the Costco model, it's kept the price of pizza extremely low, even though there's been rising costs. We all know it with food and cheese and beef. Domino's is now 10% owned by Berkshire Hathaway. This is pretty interesting to us. Domino's is not a gigantic company. It's a $13 or $14 billion market cap. So what is Berkshire doing with owning 10% of it? Berkshire has experience with quick service restaurants. It owns Dairy Queen. Maybe it sees a potential acquisition of Domino's. Company's going to report earnings next week. We still see the company adding same-store sales growth of 2 to 3% a year. Lots of tailwinds for international expansion. Company buys back a lot of stock. It's a royalty model, so it generates a lot of free cash flow. And the pizza, whether you like it or you don't like it, it comes hot, fast, fresh, and pretty reasonable price for what you're paying, and especially in this environment when everything is so expensive. To get a pizza for that value is pretty good.
We'll order a pizza. You're in for $50.
I'd order a pizza right now. I'm starving. I didn't eat breakfast.
There used to be a place in Toronto that did 24-hour pizza. But anyways. And is pizza kind of one of the recession-proof foods, too?
Maybe, although we are watching what's happening with these GLPs, right? These weight loss drugs are people.
Yeah. Oh, yeah. It's
right?
in that as well right now.
We hear that people who are on them, carbs are tough to eat. They may not eat as much, right? This is high-calorie food, so it's something to watch for. On the other hand, pizza's kind of like, it's a junk thing. You order it when you have a football game. You order, your kids will order it, right? And so I think it's one of the more recession-proof, high-quality type foods that you can hold for the long term. And Domino's will probably continue to add more products and change as the world adapts to changing tastes.
And how much of the market do they own? How big are they?
They're over 50% of the market in terms of delivery and carry out in the U.S., and still more room to grow. Pizza Hut and Papa John's have both of Papa John's is apparently up for sale. The management hasn't delivered. Pizza Hut is inside of Yum Brands. Their results have not been strong. And Domino's just continues to pound them on lower pricing, better coupons, better offering, better technology. So wonderful business, and I can't believe it's trading at this kind of valuation. So here's our chance.
Is there any concerns as to why it's trading at that, though?
I think there's worries about the low-income consumer being able to afford fast food. You look at the share
economy, right?
Yeah, look at Wendy's stock has done terrible. But on the other hand, you saw results from McDonald's and Burger King, Tim Hortons, which were pretty good. So I guess if there's a value offering with the product and it's good quality, people are still going to come back.